Hi, how are you? It's Matt Heiser from Vanderbilt Properties, and today we're going to talk about reverse mortgages. I'm going to talk a little bit about what a reverse mortgage is, but I'm sort of assuming that if you're thinking about a reverse mortgage, you understand the basics. And then I'm really going to talk about what your other options might be, the kinds of other things that you might want to consider, specifically downsizing, to kind of see whether or not these things all sort of make sense. So I know for a lot of folks that are trying to solve this problem, they have a lot of different opinions from people that they might ask. And of course, if you ask a loan officer, he's going to say, well, a reverse mortgage is the best thing you can do. And if you ask a real estate agent, they might say, well, downsizing is the best thing that you can do. So I'm going to try and present both of those things as potential options so that you can kind of see the trade-offs, which I hope will be useful for everyone. But the simplest way I can explain a reverse mortgage is that it's a way to use the equity in your home, and basically you borrow against the equity in your home, and you do that until the home is sold, at which point in time that debt is paid off. So unlike a traditional mortgage where you make payments and you pay down the loan balance, with a reverse mortgage you actually can take money out, literally take money out of the house, and then pay it back later. Now, that's a really neat trick, and it doesn't happen for free, and so part of this video is going to be talking about the costs that are associated with it, and hopefully what I hope is a simple way. So for most reverse mortgages, they may make sense for you if you have hundreds of thousands of dollars in equity in your home. They don't tend to work very well over small numbers, someone generally needs to be 62 years or older. So there are exceptions. There are a lot of products out there, but the standard product, if you will, is an HECM, a home equity conversion mortgage, and that product requires you to be 62 years old. So whatever reverse mortgage you look at, you definitely want to make sure that you read and understand the fine print. You'll get several opportunities to do that. The loan officer will go over some stuff, and there's other safeguards put in. We'll talk about those. But just very basically, it's expensive financing, and that doesn't necessarily mean that it's bad, but it is more expensive than other types of financing. So you want to make sure that you're comparing all the different types of financing before you make a decision. So, thinking about the math is what we're going to do here today. So if you're just joining us, my name is Matt Heisler. I have been selling real estate for 22 or 23 years or so. I'm not an attorney and I'm not a lender. I'm just a real estate agent, but I have helped many people downsize, and I find that many of them are asking the same sorts of questions, and this is the sort of channel that I do, is to talk about these kinds of issues, and I try to do it in a neutral and non-judgmental way, and we try to see where it goes. So why might you do a reverse mortgage? Well, if you do have a lot of equity in your home and you'd like to access it to live on, you may find that it is difficult to access, especially if you are retired or otherwise unemployed. And the reason is because a bank is going to look at your income, and if they don't think your income is sufficient, then they're not going to let you do a traditional refinance or get a home equity loan. So a reverse mortgage is a way to access that equity in your home, which you have earned, by the way. It is your equity. You have earned it. You should have access to it. And a reverse mortgage will allow you to access it and to stay in the property that you are in for a much longer time than you might be able to otherwise. So the good news is that although they're expensive, some of those expenses may be offset with the appreciation that you continue to earn in your primary residence. So we will take a look at that. But before considering a reverse mortgage, I generally encourage people to make sure that they have ruled out the other options. So if you can do a regular refinance because you have enough assets or you have enough income, generally you should do that. That is cheaper. If you can do a home equity line, generally you should do that because it is cheaper. Now, one of the problems with doing it that way is you may not be able to access the full amount of equity in your home. Like, you can't get 100% mortgage, right? Like, even if you refinance and you have the assets to do it, they probably will stop you somewhere around 80-20 for a traditional refinance situation. So, and for a home equity, they may stop you at 75% of the total equity in the house. But of course, if you do not have any income and you're talking about a tremendous amount of money that needs to be paid back, then the bank may say, no regular refinance, no home equity, you can't do either of those things. That still leaves one option. One option is to downsize. And so I do talk with a lot of people about downsizing. Oftentimes there's usually one person who wants to downsize and one person who's less excited about it, but it does have some significant options. So if you have a larger house, usually a house larger than what I would say is 2,500 square feet, and if you're trying to get into a smaller property, you can usually get the numbers to work if you've lived in that house for a long time and you have plenty of equity. And of course, the larger your house is, generally the better those numbers work. And another way to make them work is to go from the town that you're in to a less expensive town. In Massachusetts, that usually means going north, south, or west of where you are, but sometimes you can do it another way. And generally, if those are the parameters that you're sort of working with and you'd like to know more about what your house is worth and what you might have to pay in order to downsize, that's a good time to give me a call. I'm happy to help you walk through those numbers or build a spreadsheet if you're so inclined, and then we can talk about what the downsizing numbers might be. So downsizing, sometimes I get called about downsizing and the numbers just don't work because there isn't enough equity in the home, or the house isn't, you're going from 1,600 square feet to 1,200 square feet. That's probably not going to work as far as a downsizing option unless you're switching towns and the second town is quite a bit cheaper. Now, when we look at the kinds of costs that you typically have to pay for any kind of financing for a house, we'll start with your basic refinancing option. That's usually around $4,000. This doesn't count a lot of the closing costs that come back to you, but just the costs to the bank to do the loan. It's usually $4,000 or less. And a HELOC is even less. A HELOC is $1,000. Now, the big difference is if you refinance, you're going to get a fixed rate most of the time, or an ARM that's good for 5 or 7 or 10 years. And a HELOC is going to float. It's going to have a floating rate most of the time, but there are a lot of different products. But at the end of the day, that's a relatively inexpensive way to access a great deal of money and equity in your home. So those are good products to look at. And if you're thinking about retiring but not retired yet, this might be something that you want to look at, because if you refinance, they don't ask for the money back. So just because you have retired. But if you've already retired and the bank is not enthused about either of those options for you, then you'll want to look at downsizing, probably. And downsizing is a good option if you plan to move. And what a lot of folks, the way they try to work the numbers is they try to take the equity in their home and pay cash, use all that equity to pay cash for the next house that they're going to. And that can be a great financial move, because now you no longer have a mortgage. You're not as levered to the housing market, so the appreciation that you get for your house is a little bit less. But it gives people a lot of security knowing that they do not have a mortgage. They're only going to be responsible for taxes and maybe HOA fees and maintenance. And while that's not nothing, it's better than having a mortgage to pay. So downsizing is definitely an option. A lot of people in this situation who are looking to get the equity out of their home and do something with it, downsizing is a great way to do it. Reverse mortgages, especially HECMs, those home equity conversion mortgages, they unfortunately have very high bank fees. Okay, I'll call them closing costs. It tends to be $20,000 to $40,000 in order to open a home equity conversion mortgage. And then on top of that, you have to pay a special kind of PMI, which is around 2% of the entire loan balance, and you have to pay that every year. So on top of that, the loan rate that you're going to get is going to be higher than what traditional financing is. So there are really 3 different ways that a reverse mortgage is more expensive than the other kinds of financing. And I actually think that those costs are set up that way because they know that people who are downsizing are thinking about, moving and commissions and all those things. And when you add them all up, those things are between $20,000 and $40,000 too, usually. So the cost for a reverse mortgage and the cost of downsizing are about the same. So the tricky part that you have to remember is if you do get a reverse mortgage, you may still want to downsize later, in which case you'll basically be paying those costs twice. So that's a hard thing to sort of figure out, but if you really want to stay in your home and it's worth the double payment there in order to stay, then a reverse mortgage is really the right solution for you. So let's see, what else here? Safeguards. Because of the higher costs and the fees that are associated with a reverse mortgage, in Massachusetts and I think across the country probably, a loan officer is going to refer you to someone who does not work for the bank or the loan officer to make sure that all the expenses and the benefits of a reverse mortgage are covered, that they've been explained to you. And that is a good thing. I mean, ultimately, I think for a lot of folks when they're making financial decisions, they want unfiltered advice. They want the real information so that they can make the best decision for themselves. This is clearly an effort to make sure that people who get into this product understand it. Does it work for everyone? I don't know. I think the calls are helpful, especially when they're done right. I hope it works for you. But at least they're trying, right? At least they're trying to make sure that you understand what is a more complex financial product. Most people will only get one reverse mortgage in their whole lives, right? So it's the only time you're going to do it. So it's definitely good to get as many people weighing in on what it is and how it works as possible. So, but the $64,000 question is, should you do a reverse mortgage? And as I've sort of hinted to in this video, I definitely want to make sure that you've eliminated all the other options, because on a cost basis, they are a lot cheaper, right? A lower interest rate, a lower entry cost. If you can do some other type of refinancing to access that equity, it is a good thing to do, right? And if you downsize, basically the feedback that I've gotten from folks is that they generally do it because they feel safer, right? Paying off that mortgage is a huge weight off their minds. That is usually the driving force for people who are downsizing, is to try and get rid of as much of that mortgage as possible or eliminate it altogether, which is a great thing to do, as I mentioned. And so it certainly should be an option that most people consider. But if you want to really stay in the home and you can't use any of the other financing, probably can't beat a reverse mortgage for that. That is really like the best solution for it. But I do remind people that just because you now have access to all that equity, you still want to be pretty budget sensitive about it. You don't want to be running up that balance very quickly, because once it's gone, it's gone. And unfortunately, because you are paying interest on whatever you pull out of your house, as that balance grows, so does the interest payment. So it can really, the clock can really start to run on it, and it means that you'll run out of equity sooner than you might otherwise, and that you don't want to be in that situation, right? Like, so, you do still need to have a budget. You do still want to be careful to make sure that that equity that you've worked so hard to put together doesn't run away in a short period of time. So, okay. If you still have questions, I am certainly happy to help with any downsizing math that you might want to do, how much your house might be worth, or how much it might cost to go somewhere else, and what that might look like, and how old it might be, and how nice, and what kind of work you might need to do at your place in order to get the price that you want for it in today's market. I'm happy to help with all of that. And if you look at those numbers and they don't work for you and you're not ready to downsize, I am happy to refer you to someone who does reverse mortgages. So there are lots of people who do them. Or if you can still do the regular mortgage, I can refer you to someone that way also. And I think my goal here is really to make sure that you're getting the best advice for you. I don't think two people, who are in similar situations would necessarily always make the same decision. And I think that's what's really interesting about a reverse mortgage or the downsizing choice, is that similar people would make different decisions based on how much risk that they want to do and the kind of way that they want to structure their finances. And I think both solutions are good. So hopefully you agree, and I hope this video was helpful. Don't forget to subscribe. We'll probably talk more about these kinds of situations later. Take care.